But if there is a contingent beneficiary above the primary, she could do a qualified disclaimer and give that $1 million IRA to, say, her son, no gift tax. And she's just moved $1 million out of her estate. It's a big benefit, folks. So have a primary beneficiary and a secondary beneficiary. And number 3 is that retirement accounts have kind of quirky rules about them. But here's one that might be beneficial to you. If you are a non-spouse and you inherit an IRA from a parent, you're a child, you're not a spouse of the deceased person, you have to leave the deceased person's name on the account and put FBO for the benefit of, and then your name. That keeps it in a tax-deferred environment. But there's something else that might be more beneficial to you. Let's say your mother survives your father and she's 60 years old and you're in your mid-20s. If you inherit that IRA and you do it correctly by keeping the deceased name on there, you have to start taking distributions a year after the death of your father. So the distributions have to start very quickly, and they go for the rest of your life. And they're based on your life expectancy table. However, let's say we had that same scenario, but the mother inherits the IRA with the intent of holding it for you, and she's 60 years old. She can hold that retirement for 10 and a half years without any distributions until she's 70 and a half, and then give it to you. That gives you over 10 years of growth and tax deferral. So you'll want to do that. Number 4, naming a minor is a quick ticket to probate. Don't name a minor as a beneficiary because someone will have to watch the distributions, and that is very, very, very expensive. And most of the time, they have to be court appointed, which we're back to probate. And finally, number 5, changing your beneficiaries is as easy as changing the filter in your coffee pot. You just call up, get the paperwork done, sign it, you're finished. Folks, those things right there can save your heirs headache, heartache, and possibly financial ruin, and your hard-earned money goes where you want it to go. All right, folks, now it's time for one of our favorite segments, Rapid Fire.
It's time for your outspoken emails to be heard. This is Rapid Fire.
All right, folks, welcome to Rapid Fire. This is where I take your emails that you send us, read them on the air, and answer them. I have 30 seconds to answer each question. So let's get started. Question number 1. Dear Steve, I am in my late 60s and have learned for the first time about having to take money out of my IRA when I'm 70 years old. Can you explain this to me? Thank you. Signed, Dorothy T. from Magnolia. Start the clock. Dorothy, it's called RMD, or Required Minimum Distribution. It starts when you're 70 and a half. Ever since the 1970s, when the IRA was invented, the government has been waiting to get their tax dollars away from you. And so they force you to start taking money out at 70 and a half, and it starts at 3.67%, and it climbs up from there until one of two things happen. You empty your IRA completely and you pay all the taxes, or you leave it to someone else and they continue to draw it out till the government gets all their money. Number 2, you mean Wall Street. Is gold a good investment? Some are saying it is the only investment that will have value and all this government spending unwind. Signed, Joseph J. Bologna. Hit the clock. Joseph, gold is at a very, very high price right now. Gold hit $800 an ounce in 1980, and for 27 years, it never regained that value. It stayed below 800 for 27 years. Gold, in my opinion, is way too expensive. Stay away from it. Go ahead and buy it when it drops down, but stay away from it now. Look at other alternate investments that might satisfy your needs without buying something that could go up, but could go down. And I don't know anybody that's got 27 years. They can wait until the market comes back. Number 3, Dear Steve, your show has made me think about rolling a 401k I've left with my former employer for years. To get this out, will there be any penalties when I roll it over? Signed, Robert G. from Morrilton. Robert, you're on the right track. You want to get that thing rolled over into an IRA because a couple of things happen. No one is looking at it or watching it where it is right now, but in an IRA, you'll have an advisor that will help you manage that money, that pre-tax money. There'll be no penalties to this whatsoever if it's a qualified rollover. And what you have to do is go to the old 401k company, get their paperwork, take it to the advisor of your choice, have them help you fill it out, send it in, they'll roll it over, and you can invest it in things that fit your objective. And finally, number 4, dear Mr. Kiefer, I'm retiring for the first time. I'm thinking about my investments and researching them more than ever. Good for you. I'm talking to some of my friends, and in my research, I'm interested in annuities. For some reason, I've always heard that I should not do annuities. Are annuities good or bad? Sincerely, Tom W. from Otter Creek. Let's hit the clock. Tom, great question. There are good doctors and bad doctors. There are good lawyers and bad lawyers, good advisors, bad advisors. There are good annuities and bad annuities. The variable annuity has come a long ways, and there's some very, very good writers on those. Now, I'm not going to give you any specifics, and I'm not recommending you go out and buy one, but I'm saying don't close your mind, don't stereotype all annuities, because there may be one out there that fits your needs perfectly. But then again, there may be none that fit your needs. But all I'm asking is keep your mind open. If you need more information, folks, go to youmeandwallstreet.com. Robert, tell them how they can send us an email.
If you have an investment question or comment you would like answered on air, send those emails to rapidfire at youmeandwallstreet.com.
All right, folks, welcome to the chalkboard time of our show. Would you agree with this statement? The way to make money in the market is to buy low and sell high. If you agree with that statement, I want you to physically nod your head right there in your living room. Yes, I agree. Every one of you, I want you to nod your head with me if you agree with that statement. The way to make money in the market is to buy low and sell high. Well, we're going to talk about 4 stages that can either make that happen or can cause you to do the exact opposite, buy high and sell low. And I think this is going to be very, very educational for you when you see all the factors that are working against you, but there are some factors working for you, and those are the ones you have to find to make this a reality. Now, let me draw the circle that represents the cycle of the market. Now, this may be a review for some and it may be new for others, but as we know, the market does work in a cycle, and we're just going to go clockwise with this. And at the top at 12 o'clock is the peak. That's when the market hits the highest point, like it did back in October of 2007. And then we have the trough, or the bottom, and so far, March 9th at 65.40 seems to be the low. May not be, we may go back lower than that. 3 o'clock, 6 o'clock, 9 o'clock. So this might be a repeat for some, but I want to do something a little different with this tonight. I want to show you the 4 quadrants, or 4 stages that appear every time. This is like clockwork. This happens every time. Just as the market works cyclical, every time, no matter what people say, it's going to do this. And I'm going to show you the quadrants that occur from that. And let's just divide this up into 4 quadrants. Now, get my little cheat sheet here. First of all, I'm going to give you the reality. This is bad value. In other words, we don't want to buy here. If the market's going to drop, we certainly don't want to buy at this point. Then we get to this second quadrant, and we have good value. We may not buy at the bottom, but if we buy somewhere in this area, we are heading for and toward a upward trend, which will reward us for buying low. Now over here, we continue with a good value. Certainly we want to buy somewhere in here because we have a lot of upward swing left in this market. But when we get to this quadrant, it goes back to a bad value. Now these I consider constants. These don't change, folks. These are always the same. We don't want to buy in here because we may get a little bit of bump up and think we're doing good, and then suddenly we hit the drop off. So bad value, good value, good value. Makes sense so far, right? Well, let's talk about the media. What does the media say? And they're pretty consistent. I can't say they're constant.